Okay, good morning friends. We are on lecture number 3 today of our regular batch of version 4. Friends, what I remember yesterday I had told you to solve the basic questions of marginal costing at home on rough paper, that is from question number 3 to question number 11. What will happen? This will test your knowledge of marginal costing of intermediate level. That was one advantage that you can also try and see, because you should find these questions simple. You should find these questions simple. They are not final level questions. Secondly, today I can save some time. Otherwise, I have to allow you to read and try on rough paper. So today what I'll do, I'll just go through the question, and without waiting for much time, I will directly go to the answer also. Okay, my dear friends. So I'm taking you to question number 3 now. Question number 3, page number 179. Okay, so I'll read out question number 3. Yes, these are basic or simple questions of intermediate level, my dear friends. Question number 3. S Limited furnished you the following data relating to half year. This data is relating to half year ended on 30th September 2016. Fixed expenses are given, sale value is given, profit is given. During the second half of the year, the company has projected a loss of rupees 10,000. See, in the first half, you are earning a profit of 30,000, but in the second half, you are expecting a loss of rupees 10,000. Now calculate. Number 1, the break-even point and margin of safety for 6 months ended on 30th September, that is this one. It means for first half of the year, first 6 months of the year. So you have to calculate BP and margin of safety. Now in this question, you cannot calculate BP in units because selling price per unit is not given to you. It means in this question, BP will be calculated compulsorily in rupees, in sale value, and margin of safety also will be in rupees. This is the first part is for first half of the year. Now second part, which is little interesting, and I am very confident that almost all of you have tried it at home. The expected sale value, sales volume is value you can treat for the second half of the year, assuming that PV ratio and fixed expenses remain constant for the second half year also. So assuming whatever PV ratio was there in the first half, same will prevail in the second half. And whatever was the fixed cost for the first half, this fixed cost is given to you already, that is 45,000. This is for half year. So same fixed cost will remain for second half year also. Assuming fixed cost and PV ratio constant, you have to calculate the expected sale value for second half of the year. And the third part of the question says you have to calculate break-even point and margin of safety for the year ended 31st March 2017 for the whole year. It means first part of the question is for first half year, second part of the question is for second half of the year, and third part of the question is for the whole year. So you have to solve it in 3 parts. And all of you must have tried, your answers might be ready on rough paper. Now write down the fair answer from my screen and you can cross check. And even if you have made a mistake, doesn't matter. If you are getting correct answer, fantastic, nothing like it. Absolutely very good, fantastic. But even if you make a mistake while solving the question, doesn't matter. You will get an opportunity to learn and correct yourself with the basics of marginal costing before we start with the CA final journey, right? So I'm taking you to the solution now. Let's go. We'll do it for the first half. I'll just take you back to the question. My dear friends, fixed cost plus profit is contribution. If you remember, contribution minus fixed cost is profit. So your formula will become contribution is equal to profit plus fixed cost, correct? We had done this yesterday, 1 to the 4, right? By twisting the formulae. So if you add these two, fixed cost and profit, you will get contribution, and contribution divided by sales, you will get PV ratio. And PV ratio you can use for calculation of BP, that is fixed cost divided by PV ratio, you will get BP. And total sales, that is 1,50,000 sales minus your BP sales, you will get margin of safety, isn't it? So let's go. Write down question number 3 by 179. Now you know our system of giving question number, page number, right? And you will assign the corresponding number in your notebook also, correct? cross reference. In your notebook you will write this number and notebook page number you will write against the question in the printed notes. Okay. So question number 3 by 179, S Limited. Number 1, answers for 6 months ending on 30th September 2016. Answers for 6 months ending on 30th September 2016. Just give the heading. Okay, write down below. The original formula, contribution minus fixed cost is profit. Contribution minus fixed cost is profit. Written. Therefore, contribution is equal to profit plus fixed cost. Therefore, contribution is equal to profit plus fixed cost is equal to 30,000 plus 45,000. 30,000 plus 45,000 is equal to 75,000. Is equal to 75,000. PV ratio is equal to, now naturally PV ratio is contribution upon sales. So PV ratio is equal to 75,000 divided by 1,50,000 into 100. 75,000 divided by 1,50,000 into 100. So that becomes 50%. And the same PV ratio 50% will prevail for second half of the year also. Okay. Now my dear friends, you are writing the fair answer. Though you have done it already on rough paper, now you will write it step by step. BP value is equal to, and in this question you will get BP as I said only in value, units not possible. BP in value is equal to fixed cost divided by PV ratio. BP in value is equal to fixed cost divided by PV ratio is equal to rupees 45,000 divided by 50%. Rupees 45,000 divided by 50% is equal to rupees 90,000. Is equal to rupees 90,000. And MOS value, margin of safety in value, is equal to total sales minus BP sales. Is equal to total sales minus BP sales is equal to 1,50,000 minus 90,000. 1,50,000 minus 90,000 is equal to rupees 60,000. 1,50,000 minus 90,000 is equal to rupees 60,000. Now my dear friends, all these answers are for 6 months because this fixed cost is for 6 months. This 45,000 fixed cost is for 6 months. It means you should generate a sale of rupees 90,000 in 6 months to achieve break-even point, that is to recover the fixed cost. This margin of safety is also for 6 months. This sale is also for 6 months. All the data is for 6 months. Now we go to second half of the year and that is very interesting. Now my dear friends, for second half of the year the loss is expected, right? That is what is given in the question. Now the same formula, this one, contribution minus fixed cost, instead of profit I will make it loss. It will become negative. Now you shift the loss here, so it will become contribution plus loss and fixed cost will get shifted to right hand side. So fixed cost will become positive. It means the formula of contribution will become contribution is equal to fixed cost minus loss. Sorry, I have made some mistake. We have to calculate contribution, so I will shift fixed cost here. So it will become positive fixed cost and this was a loss, so it will remain minus loss. It means formula of contribution will be contribution is equal to fixed cost minus loss from expected loss, and fixed cost will remain same for second half. So you will get contribution for second half and contribution divided by PV ratio, you will get sales for the second half, and that is the answer. Contribution of second half divided by PV ratio, and your answer is ready. So number 2, calculation for second half year. Calculation for second half year. right? Keep your printed notes in front of you so that you can keep watching or observing the question, or you can take the data from the printed notes. Okay. Calculation for second half of the year. Contribution minus fixed cost is equal to loss. Loss in the bracket because it is negative. Contribution minus fixed cost is equal to loss. This is our original formula. That is golden formula. Therefore, contribution is equal to fixed cost minus loss. Loss was already carrying a negative sign. Contribution is equal to fixed cost minus loss is equal to. Now for second half year, the fixed cost is same, that is 45,000, but loss is expected minus 10,000. It means you are able to generate a contribution of 35,000. Actually, your contribution is falling short to recover the fixed cost. It is falling short by how much? 10,000. That is what is the loss. You have earned lesser contribution than fixed cost. You are unable to recover the fixed cost, right, from available contribution. That is why there is a loss. And this is the original formula of PV ratio. PV ratio is equal to contribution divided by sales. PV ratio is equal to contribution divided by sales. And I will twist this formula again, 1 to ka 4. Therefore, you will get the formula as sales is equal to contribution upon PV ratio. Write down, sales is equal to contribution upon PV ratio. See, even if you write this formula directly, absolutely no problem. But if you are unable to recollect this formula correctly, then you have to first write this one and then convert it like this, just to avoid the mistake. But if you are comfortable and you can directly write the second formula, you can avoid this step. Okay. Now is equal to 35,000 divided by 50%. 35,000 divided by 50% is equal to rupees 70,000. So this is the sales volume for second half of the year. Now my dear friends, we got the figure for first half. We have got the figure for second half. Now add them together. So you will get the data for 1 year. So we will get the yearly data now. After writing 70,000, I am taking you further. Number 3, write down calculations for the year ending on 31st March 2017. Calculations for year ending on 31st March 2017. That is annual fixed cost is equal to annual fixed cost is equal to 45,000 for first half, 45,000 for second half. So it will become rupees 90,000. So 45,000 plus 45,000 is rupees 90,000 is annual fixed cost. Annual BP in value. Annual BP in value is fixed cost divided by PV ratio. Annual BP in value is fixed cost divided by PV ratio is equal to 90,000 fixed cost divided by PV ratio is constant, that is 50%. So divided by 50%. I hope mathematically you won't add two PV ratios. PV ratio is numerator divided by denominator. So that is constant throughout the year. That is 1 by 2. Okay. Otherwise, non-math students will say 50% for first half and 50% for second half. So 100%. Don't do that. That is not for percentage. Okay. So just 50%, which is constant throughout. So 90,000 divided by 50% is rupees 1,80,000. Is rupees 1,80,000. And if you are not comfortable with this, then calculate BP for first half, calculate BP for second half, add the 2 BP. So naturally it will be total of the 2, right? BPs. Now we'll get margin of safety for the year. So annual MOS is equal to annual margin of safety is equal to total sales minus BEP sales is equal to total sales minus BEP sales is equal to written. Now check total sales. 1,50,000 was already given for the first half. For second half, we calculated expected sales 70,000. So this will become your total sales for the year, and this minus BEP sales. So in the bracket, you will write 1,50,000 plus 70,000. 1,50,000 plus 70,000, that is total sales, minus 1,80,000. From annual sales, you will deduct annual BEP. And I hope you are performing the calculations also using calculator. Keep it ready always. So rupees 40,000. Rupees 40,000. Done, friends? Now we move to question number 4. Simple questions, right? And most of you must have done it correctly, solved it correctly at home. Question number 4, page number 179. Taking you to the question. Okay, this is question number 4. Calculate break-even point from the following figures. So you have to calculate BEP from the following figures. Data is given for year 1 and year 2. Sales is given in rupees lakhs. Profit is given in rupees lakhs. From this much data, you have to calculate BEP. Then there is one more part of the question. Second part of the question, I will discuss it later. This part I will discuss later. Let us first concentrate on calculation of BEP using this much data. Sales data for 2 years and profit data for 2 years. Now as you have tried at home, what should click to your mind? Differential formulae, shortcut formulae. That is change in profit or difference in profit. Difference in profit divided by difference in sales. What you should get? Difference in profit divided by difference in sales. You should get PV ratio. Why? Profit changes due to change in contribution. That is what we had discussed. And total cost changes due to change in variable cost because fixed cost remains constant. So change in profit is nothing but change in contribution. So it will become contribution upon sales. Change in profit is change in contribution upon change in sales. Contribution upon sales into 100. So you will get PV ratio. Now once you get PV ratio, then you can substitute that data of PV ratio in either year 1 data or year 2. Suppose we multiply PV ratio with this sales. Once we get PV ratio into sales, you will get contribution. And from contribution, if you deduct profit, you will get fixed cost. Am I right? From contribution, if you deduct profit, you will get fixed cost. First, you will get PV ratio using differential formula. Using PV ratio, you will get contribution, that is sales into PV ratio. Now, our original formula is contribution minus fixed cost is profit. So, can I do like this? Contribution minus profit is equal to fixed cost. We had done this 1 to 4. So, you will get fixed cost and then fixed cost divided by PV ratio, you will get BEP. That is how the answer will be there. So, let's write it down. This is just for your testing, your answers, whatever you have calculated, BEP and profit. Second part of the question is to calculate profit. Anyway, I'll take you directly here. Write down question 4 by 179. Question 4 by 179. PV ratio is equal to difference in profit divided by difference in sales into 100. See, I have written it in one line. If you want, you can write like this: difference in profit numerator divided by difference in sales denominator. You can write like this into 100. So, difference in profit divided by difference in sales into 100. Difference in profit is 6 lakh, difference in the profit, and difference in the sale value of 2 years is 15 lakh. So 6 lakh divided by 15 lakh into 100. 6 lakh divided by 15 lakh into 100. So that comes to 40%. Just check. Right? Keep using the calculator as far as possible. Though I am providing you the ready-made answer, but keep the habit. Keep the habit of writing, keep the habit of calculation, and keep the habit of thinking, because then only you can sustain in the exam hall. Otherwise you won't be able to sustain. If you switch off your mind, if you switch off your calculator and efforts, and if you only copy the answer, and these are basic questions, my dear friends, if you only copy the answers from screen, naturally you will not be able to survive in the exam hall, and that is very important. You have to survive there and become chartered accountant, and these are very simple questions. Okay, total fixed cost is equal to, our reshuffled formula. Total fixed cost is equal to contribution minus profit. Total fixed cost is equal to contribution minus profit. Now I've used the data of year 1. You can use even the data of year 2. You will get the same answer because fixed cost will remain same whether you do it from year 1 data or year 2 data. I have used the data of year 1. So I have taken sales into PV ratio to calculate contribution. Right, sales into PV ratio minus profit. And you get it as 64 minus 4. That is 60 lakhs. So your fixed cost becomes 60 lakhs. And we have used the yearly data. So naturally your fixed cost will also be for a year. So this is yearly fixed cost 60 lakhs. Now BP is very simple. So first answer number 1, BP sales is equal to fixed cost divided by PV ratio. BP sales is equal to fixed cost divided by PV ratio is equal to 60 lakhs divided by 40% is equal to 60 lakhs divided by 40%, and that is equal to rupees 150 lakhs. 60 lakhs divided by 40% is rupees 150 lakhs. Now this is first answer. Now there was one more question which I did not read, so I'll read it now. I'll read that question now. Check, there was one more part of the question. From the above data, predict variable cost, contribution, fixed cost and profit associated with a sales volume of rupees 250 lakhs. It means if sales volume word is sometimes used as a substitute for sale value, okay, by the institute. So if your sale value or total sales volume is rupees 250 lakhs, then what will be the variable cost, what will be the contribution, what will be the fixed cost and what will be the profit? That is what they want. And set out your prediction in a form of a profit statement. Give this in a statement format, profit statement format. So what we'll do, we'll prepare a profitability statement. We'll start with sales. Sales 250 lakhs. Now if you know PV ratio and variable cost ratio are complementary to each other. Like our PV ratio was, if I remember, was 40%. So your variable cost ratio will be 60% of sales. So we'll write sales, we'll take variable cost, we'll get contribution, fixed cost will remain the same, and you'll get the answer. So write down. Number 2, statement of profit. We have to give this prediction in a profitability statement format. So statement of profit, particulars, rupees lakhs. Statement of profit, particulars and rupees lakhs. Sales is given to you, that is 250 less variable cost. I have taken 60% from where? Because PV ratio was 40%. So variable cost at the rate of 60%. Naturally it is 60% of sales. So variable cost at the rate of 60% of sales, which comes to 150. If you deduct variable cost, you will get contribution. So contribution is remaining 40% of sales. So contribution will be 100. And how much fixed cost we had calculated? I think 60 lakhs. So less fixed cost 60, less fixed cost 60, and you get the profit, expected profit, that is 40. It's a simple journey to begin with, my dear friends. Slowly we'll step up, slowly we'll press the accelerator, right? Done? So we go to the next question. Next is little interesting one. Okay. Assuming you have finished this, We go to question number 5 on page number 179. So I am taking you to question 5. Check question number 5. ABC Limited furnished you the following data for 2020, means for the year 2020. But data is given to you as January to March, that is 3 months, and April to December, that is 9 months. So the yearly data is broken down into 3 months and 9 months. Sales is given for 3 months, for 9 months. Profit is given for 3 months and 9 months. And what you have to find out? You have to find out break-even sales for 2020. 2020 is a year. It means you have to calculate BP for a year. Don't forget that. And number 2, annual sales. Again, annual sales required to earn a profit of rupees 1,20,000. So if you want to earn a yearly profit of 1,20,000, then what should be the sales for a year? Because question is asked for a year. Okay, most of you must have tried this, right? I hope, and most of you must have got different answers. So we'll be starting directly with the solution. Now please remember, just now in the earlier question I had used the formula of differential profit divided by differential sales. Differential profit is due to contribution, so it becomes contribution upon sales into 100. It means by differential profit upon differential sales you will get PV ratio, correct? But this time you will not get it. This time if you use this data which is given to you in the question as it is without any modification, you won't get PV ratio. Now your question will be, why we won't get PV ratio? What is the problem then? So the problem is that data is for 3 months and 9 months. Now what difference it makes? The 3 months period will contain 3 months fixed cost, and 9 months period, that is April to December, will contain 9 months fixed cost. Naturally, like to calculate this net profit for 3 months, January to March, you must have deducted 3 months fixed cost, and to calculate the profit of April to December, you must have deducted 9 months fixed cost. Do you think 3 months fixed cost and 9 months fixed cost will be same? Naturally not, because fixed cost is a period cost. Important thing, whatever I discussed earlier, please remember everything is important. I had discussed with you the concept of product cost and period cost. Fixed cost is also known as period cost because it is attached to time period. Now 3 months fixed cost and 9 months fixed cost will not be the same, and if fixed cost is not equal, then the differential formula won't work, because differential formula works only when fixed cost is constant. So profit changes only due to change in contribution, assuming fixed cost remaining the same. Please remember, there was one silent assumption behind those differential formulae, and that silent assumption was that fixed cost is remaining constant. But 3 months and 9 months fixed cost will never be same or never be constant. 9 months fixed cost will be 3 times of 3 months. In short, we'll have to modify the data to get the answer. Now what modification we'll have to do? Because as it is, you won't get the answer. So what we'll have to do? We'll convert either 3 months data into equivalent 9 months, or 9 months data into equivalent 3 months. Or you can convert both the data, 3 months data and 9 months data, into equivalent at 12 months. That doesn't make any difference. You convert it into any period, but keep the period same. It means when you use the differential formula, the data for this period and the data for this period should be the same. The period should be same. The moment period becomes the same, fixed cost will become same. And if fixed cost becomes the same, the differential formula will start working. Meaning, what I'll be doing in my answer, I'll convert 3 months data by multiplying it by 3 times. 3 months data into 3 times will become equivalent to 9 months. It means I'll convert this data by multiplying it by 3. So this will become 3 into 3, this will become 9 lakh, and 10,000 into 3, this will become 30,000. Now both the data, this is also for 9 months, this is also for 9 months, right? Now I'll use the differential formula, change in profit upon change in sales, I'll get PV ratio. Now I'll get PV ratio because I'm comparing 9 months with 9 months. So 9 months fixed cost and 9 months fixed cost will be same. Are you getting it? This is the only trick. And once you get PV ratio, we can substitute PV ratio, calculate fixed cost, and then You'll get BEP also, you'll get sales required to earn profit also, everything you'll get. The trick is put the data on same platform. The data should be comparable, right? Let's go to the answer. This slide was for you to give the answer, whatever answer you already have for BEP sales and for annual sales. Okay, now we'll check this answer. Let's go. Write down the fair answer. Question 5 by 179. ABC Limited. Question number 5 by 179. ABC Limited. I'll give you the approach also. You'll write down the approach also. Write down approach. Question 5 by 179. ABC Limited. This is for you. This is a student note, but important one. Write down approach. The data given in the question, is for 3 months and 9 months respectively. The data given in the question is for 3 months and 9 months respectively, and hence not uniform. Full stop. In order to make it comparable, comma, let us convert January to March data. Let us convert January to March data into equivalent 9 months as follows. In order to make it comparable, let us convert January to March data into equivalent 9 months as follows. So we'll convert it and then we'll compare it. There is no other way you can solve this question. One thing is there, 9 months data can be done 1/3 and converted into 3 months and then compare 3 months. That is possible. I just said make the period same. You can compare monthly with monthly, quarterly with quarterly data. Okay, prepare these 4 columns and just 4 lines. Particulars, January to March. January to March is equivalent 9 months. April to December is already 9 months. And then the difference. Just 4 lines. Particulars, January to March equivalent 9 months. April to December is already 9 months, and then difference. Ready? The particulars I am writing sales. This sales is converted sales for 9 months, which I have already told you. 3 lakh for 3 months, so into 3, 9 lakh for 9 months. April to December is already given to you. You don't have to convert the data which is already for 9 months. So this is 12 lakh. Difference between 9 and 12 lakh is 3 lakh. And see, every question of marginal costing you may solve using some other approach also, provided your answer is correct. Your destination should be correct. Your path could be different, right? Because it is mathematics, you may follow different routes or different paths to reach to the same place. Net profit. Net profit was 10,000 into 3, so it will become 30,000 compared with 90,000, so it will become, difference is 60,000. And now this difference in profit upon difference in sales, you will get PV ratio. So write down below, PV ratio, profit volume ratio. Profit volume ratio is equal to difference in profit upon difference in sales into 100. Difference in profit upon difference in sales into 100. Is equal to 60,000 divided by 3 lakh into 100. 60,000 divided by 3 lakh into 100. So you will get 20%. Now using PV ratio, we'll multiply PV ratio with sales, you will get contribution. Contribution minus profit, you will get fixed cost. So we'll calculate fixed cost now. Okay, once PV ratio is calculated, 20%. Written? See, those who find that I am going faster, they can always use pause button, right? In the video lecture, you can pause the video, take your own time and then play again, right? I am already going slow because my speed is slow to match with almost the weak students also. But then individual speed changes from person to person, right? From very slow to very fast, your speed is different and the faculty cannot teach at all the speeds at the same time. So I try to teach generally from middle to lower speed, right? You can either increase the speed of viewing in your video because there is a speed button there, or you can decrease the speed, or you can use the pause button also if you want more time. So that facility fortunately is available with you. Now below write down using actual data of January to March we get. I am going to use actual data of 3 months. Using actual data of January to March we get. Below write down fixed cost is equal to contribution minus profit. Fixed cost is equal to contribution minus profit is equal to, I am using actual data, not converted data. Actual data of January to March was, you were given sales 3 lakh. 3 lakh into this PV ratio, you will get contribution and minus 3 months profit. So you will get 3 months contribution minus 3 months profit. You will get 3 months fixed cost because I am using actual data of 3 months. So sales into PV ratio, you will get contribution 3 lakh into 20% minus 10,000. That is 60,000 minus 10,000. 60,000 minus 10,000. So it is rupees 50,000. It is rupees 50,000. But don't forget, fixed cost is a period cost. So this fixed cost which is derived from this data of 3 months, the fixed cost is for 3 months. This fixed cost is not for a year. This fixed cost is not for 9 months. This is for 3 months. Now suppose if I use 9 months data, I will get 9 months fixed cost. I will just tell you how. Suppose I use the April to December data, right? That is 9 months data. Then sales was how much? 12 lakh. Okay. 12 lakh sales into 20% PV ratio means contribution minus profit 90,000. This will be 2,40,000 contribution minus 90,000. So how much you will get? 1,50,000. Correct? So 1,50,000 is correct fixed cost, that is for 9 months. See, this is 3 months fixed cost, this is 9 months fixed cost. 9 months fixed cost has to be 3 times of 3 months. Are you getting it? And that is why the sentence, important sentence is fixed cost is a period cost. It varies depending upon the period but not as per the production. It changes with change in time period. Now, if you remember this question, or I will take you back to the question. This question of BP is asked for a year. 2020 is a year. If you want a break-even point for a year, you have to take yearly fixed cost. You have to take yearly fixed cost for calculation of yearly BP. So I will take you back. Yearly fixed cost will be this 50,000 plus this 1,50,000. That is 2 lakh. Or simply what you can do, if 50,000 is for 3 months, how much will be for 12 months? So you can convert this fixed cost for 1 year and then you will get yearly BP. So I will convert it into 1 year. Write down. Therefore, fixed cost per annum, whatever way you do, fixed cost per annum, because we want annual BP, is equal to 50,000 into 12 months upon 3 months. Fixed cost per annum is equal to 12 upon 3. That is rupees 2 lakh. That is rupees 2 lakh. And now you will write first answer number 1, BP sales for 2020. BP sales for 2020 is equal to annual fixed cost divided by PV ratio. Annual fixed cost divided by PV ratio is equal to 2 lakh divided by 20%. Is equal to 2 lakh divided by 20%. And that is equal to rupees 10 lakh. That is rupees 10 lakh. So your BP sales is rupees 10 lakh. Right. Now I hope basic mathematics is at same place. See this PV ratio, whether you calculate for 1 unit, for 1 month, PV ratio I am saying, PV ratio, this one. For 1 year, the ratio doesn't change. Why it doesn't change? Why the PV ratio won't become 3 times of 3 months ratio? 3 months ratio 20%. So for 9 months, it should be 20% into 3. I hope this question you won't ask. But if anybody is still thinking, because you would not have reached to CA final level if you have this much problem in mathematics. But it is my responsibility to just tell you. Now suppose our contribution, suppose I take 10,000 just for the sake of simplicity for 3 months, and I take sales as 50,000 for 3 months. Okay, just imaginary figure of contribution upon sales. So your PV ratio will become 20%. But let us assume this data is for 3 months. Now for 9 months, what will happen? Why PV ratio won't change? For 9 months, the data will become 3 times. So this will become 3 times. But then denominator also will become 3 times, no? Denominator will also become 3 times. If you check the ratio, ratio will remain 20%. So ratio doesn't change, numerator, denominator. Because numerator will get multiplied by some number of times, denominator will also get multiplied by same number of times. So ratio itself won't change. This was not required. This is not required to be told in CA final batch. But then sometimes students ask this funny question, right? That why you have kept PV ratio same, why not PV ratio also 3 times? Or why yearly PV ratio is not 4 times of quarterly PV ratio? Such questions sometimes do occur, very rarely, but do occur. So just keep your basic mathematics. I need 2 things for costing, please remember. One is reasonable English, second is reasonable mathematics. I don't want very expert level, PhD level English or mathematics. Now why English is required? Because you need to interpret the question. Sometimes if you are very weak in English, you won't be able to interpret the question. You won't be able to interpret a paragraph or a particular sentence, and therefore answer goes wrong. So for interpretation of question, English is required, reasonably good English. And for solving the question, you need reasonably good mathematics. So costing is a combination of English and mathematics, I would say. And these type of questions have come, and therefore I am giving this explanation. I repeat once again, I don't underestimate your ability. Please remember, by telling you so minute things, I am not at all underestimating your ability, but such queries have come in the past. It means someone is thinking like this. Therefore I am explaining. Okay. This was BP sales rupees 10 lakh. Now second part of the question was annual sales required to earn a profit of 1,20,000. So simply speaking, desired profit plus fixed cost annual divided by PV ratio, and your answer is ready. Let's go. Number 2, write down annual sales required to earn a profit of rupees 1,20,000. Annual sales required to earn a profit of rupees 1,20,000. Write down the formula. Sales for desired profit is equal to desired profit plus fixed cost divided by PV ratio. Desired profit plus fixed cost divided by PV ratio. is equal to your desired profit is 1,20,000 given in the question plus fixed cost for a year you will take for 1 year plus rupees 2 lakhs divided by, as I said, PV ratio remains constant, that is 20%. So 1,20,000 plus 2 lakh divided by 20%, that answer comes to 16 lakh. So those who have done at home, your answer should have been 10 lakh and 16 lakh, two answers. If you have done it correctly, very good. Your concepts are crystal clear, right? Those who did this question correctly, you are very good at the basic concepts. Right. Let's go further. These are all conceptual questions, my dear friend, not CA final level questions, but conceptual questions. Let's go to the next one. Question number 6. Another conceptual question. Question number 6, page number 179. So I'll take you back to the question. Let's go to the question. Question is, question number 6, Shri Daulat Rai earns a gross profit. But this gross profit is calculated before charging selling expenses, gross profit of accounts. Naturally, gross profit is calculated before debiting selling expenses because selling expenses are debited to P&L account, profit and loss account, not trading account, correct? So he earns a gross profit before charging selling expenses of 25% of cost of goods purchased. Please remember this gross profit ratio 25% is of cost. Generally we calculate gross profit ratio on sales, but here the gross profit ratio is given on cost and incurs 5% of sales as a selling expense or selling charges. His gross profit is 25% of cost of goods purchased, but his selling charges means this selling expenses is 5% of sales. Now his fixed overheads are rupees 30,000 per annum. Fixed cost is 30,000 per annum. Now find out the extent of sales required to break even. It means break even sales. Sales required to break even is break even sales, that is to cover exactly the fixed overheads. The question is very simple to calculate BEP, but there is a trick. Trick means you have to use the accounting logic and convert it into marginal costing logic, that is CBP analysis. Using the gross profit ratio of accounts, you have to derive PV ratio for CBP analysis. Now, I hope you must have tried already. Now, those students who have not tried can do what alternatively? See, I am assuming now that yesterday the time was given to you to try question number 3 to 11 at home, correct? Now, those who have not tried, suppose, and now they want time now to read, interpret and try it on their own. If they want to try now before I give the solution, what is the option available to you is, you may press a pause button or your video, solve this question will remain on your screen, solve this question on rough paper, again play the video lecture and then check it with my answer. So this solution, this option is always with you if you have not already tried. Now I am directly taking you to the solution because I am assuming that you have already tried it at home. Okay, first I will convert the accounting logic to marginal costing logic. I hope you have read the question. I am waiting for few seconds. Read it once again carefully. And those who want to try on their own will pause the button, will first solve, then will come back to my solution. Okay, so technology has provided you this solution to increase the speed, decrease the speed, pause the lecture. Now I am going for my own discussion. Understand how to convert GP ratio, gross profit ratio of accounts, into PV ratio. Once you get PV ratio, then matter is very simple. This is just fixed cost 30,000 divided by PV ratio and your answer is ready. BP answer is ready the moment you get PV ratio. Okay, understand this. Let us say our trading account. In trading account, we take sales and after the stock adjustment, that is opening stock plus purchase minus closing stock, if you do, you will get cost of goods sold. Opening plus purchase and minus closing stock, you will get cost of goods sold. Sales minus cost of goods sold, you get gross profit, correct? And gross profit divided by sales, you get GP ratio. Is that okay? Now generally, this cost of goods sold means this cost is incurred only when you sell the goods. We take only cost of goods which are sold. Remaining stock, unsold stock, we carry to the next year. It means if you have sold 10,000 units, you will take cost also of 10,000 units sold. That is why we call it as cost of goods sold, correct? Now, in marginal costing, this cost of goods sold can be called as variable cost, because it is the cost of only those units which are sold. Are you getting it? It means this cost is variable cost. Now, treat this as sales minus variable cost. Treat this gross profit as equal to contribution. And contribution upon sales, it means GP ratio is almost close to PV ratio. GP ratio and PV ratio are very close to each other. Assuming that in profit and loss account, gross profit brought down we do, and there are certain expenses and we get net profit, correct? I am assuming here that all these expenses which are debited to profit and loss account are fixed costs. Just understand what I am saying. If I assume all the expenses debited to profit and loss account are fixed in nature, if this assumption holds good, then gross profit ratio is equal to profit volume ratio. If all the expenses debited to profit and loss account are fixed in nature, then gross profit ratio is equal to profit volume ratio. Up to this is okay. However, just a minute. However, this got deleted, my dear friends. So again, trading account, sales minus cost of goods sold is equal to your variable cost. So your gross profit is equal to contribution, and gross profit ratio is equal to PV ratio, assuming all expenses debited to P&L account are fixed. However, suppose in profit and loss account, this is gross profit brought down. These expenses are of two types. Expenses debited to P&L account is fixed cost also and some variable cost also. Like selling expenses are variable in nature. Selling expenses, sales commission is variable in nature. Then, have I deducted all variable costs from sales to calculate PV ratio? No. I hope you are getting my point. See, this one variable cost is deducted, but this one is left. So what I have to do? From this gross profit, I have to deduct this variable cost also to get contribution as per marginal costing. Are you getting it? I repeat, if all costs debited to P&L account is fixed cost, then your GP ratio and PV ratio is same. However, if in profit and loss account there are certain variable costs, then GP ratio is not equal to PV ratio. Then your gross profit ratio is not equal to PV ratio. Then what I have to do? I have to modify GP ratio. From GP ratio I have to deduct this variable cost also to get the PV ratio. And that is what we have to do in this question. I'll take you back to the question. Check this question. And please remember, PV ratio is calculated as percentage of sales. PV ratio is contribution upon sales. So denominator should be sales. Now I have to make two changes in this question. First of all, this gross profit is calculated before charging selling expense, and selling expense is a variable cost because it is 5% of sales. It means in this question GP ratio is not equal to PV ratio. Point number one. Point number two, GP ratio is given as 25% of cost. I have to change the base to sales because PV ratio has a base of sales. Now, how to change the base? Very simple. If I assume cost as 100, gross profit will be 25% of cost, that is 25, and cost plus gross profit you will get sales. Sales will become 125, and gross profit to sales ratio will be 25 upon 125, that is 1/5. 1/5 means 20%. It means gross profit is 25% of cost, means 20% of sales. Up to this is clear? This is just change of base. I've changed the base of gross profit from percentage of cost to percentage of sales. 25% of cost will become 20% of sales. That is one number, point number one. So I got 20% as GP ratio, percentage of sales. However, there is a selling charge or selling expenses which is 5% of sales. So I will deduct 5% from here, because this is one variable cost, and I will get PV ratio as 15% of sales. Now I can do the simple deduction because base is same. 5% is also of sales and 20% GP ratio is also of sales. When denominator is constant, you can directly do the mathematical calculation, that is 20% minus 5%, simple calculation, and you will get PV ratio as 15% of sales. And once you get the PV ratio, the remaining answer is simple. Correct? Let's do it. I hope you have understood what I said. I have just tried to compare your accounting with marginal costing. Should I repeat? If all expenses debited to P&L account are fixed in nature, then gross profit ratio is equal to PV ratio. However, if expenses debited to profit and loss account are variable as well as fixed in nature, then GP ratio is not equal to PV ratio. Then you have to modify the GP ratio to get PV ratio, because you have to deduct some of the variable costs which are debited to P&L account also. See, marginal costing is concerned only with variable and fixed cost. It is not concerned whether you are debiting it to trading account or debiting it to P&L account. Marginal costing is not concerned with it where you are debiting. Marginal costing is concerned only with the behavior of cost, whether it is variable cost or whether it is fixed cost. If it is variable cost, you have to deduct all the variable costs from sales to get contribution and to get PV ratio, irrespective of whether that variable cost is debited to P&L account or whether that variable cost is debited to trading account. So it is not concerned with it where you are debiting. It is concerned if it is variable cost, sales minus all variable cost, you will get contribution, and then contribution upon sales you will get PV ratio. I think this is more than required explanation given to you, just because it was a conceptual question and it was a bridge between accounts and costing, marginal costing. Start writing the solution. Question 6 by 179. Question 6 by 179. Shri Daulat Rai. Question 6 by 179. Shri Daulat Rai. Write down gross profit is equal to 25% of cost. Gross profit is equal to 25% of cost. I am giving you everything in writing. If cost is assumed to be 100, then profit shall be 25%. 25% of cost. That is 25% of 100 is 25 rupees. Profit shall be 25%, that is 25. Hence sales price will be 125. Right? Sales price will be 125, that is cost plus profit. It means gross profit is equal to 25 upon 125 of sales price. Gross profit is equal to 25 by 125 of sales price. That is 1/5. That is 1/5 or 20% of sales. That is 1/5 or 20% of sales. Right? This was the change of base for gross profit ratio. And now we go ahead. Below write down PV ratio is equal to GP ratio minus selling expense ratio. PV ratio is equal to GP ratio minus selling expense ratio. Right. As I said, you can do this simple deduction because base of GP ratio is now sales and expense ratio is also given as percentage of sales. If base is same, then only you can do it, otherwise you cannot. Is equal to 20% minus 5% is equal to 20% minus 5% is equal to 15%. 15% is PV ratio. Right. So conversion of gross profit ratio into PV ratio we have done. Now BP sales is equal to fixed cost upon PV ratio. BP sales is equal to fixed cost upon PV ratio is equal to, fixed cost is given to you in the question, rupees 30,000 divided by 15%. Rupees 30,000 divided by 15%. Is equal to rupees 2 lakh. Is equal to rupees 2 lakh. See, solution takes only just 1 minute. Calculation of the answer will require 1 minute, but thinking will take time. And now you must have got the purpose why I am revising intermediate questions, right? To put your concepts back on the track, right? To have that solid foundation to build the story of CA final. I am repeatedly saying it doesn't mean that you were not strong. You were already strong, right? Without a strong base, you would not have reached to CA final. But I am just trying to test it. I am just trying to test the foundation, right? Though it is already solid, but I am just testing it so that once we start constructing the story of CA final, right, it won't start shaking, right? It should remain solid there. That is the reason. So we go to now question number 7. Would you like to try, my dear friends? If you have not tried already at home, now you can try that question number 7, right? So it's again a simple question, but then you have to interpret this question number 7, interpret it properly and then try on rough paper. So what you can do, you may pause the video. If you have not tried already, then you may pause the video and then try on rough paper, again play and then check with my solution. Is that correct? So you get some time for trial, and those who have already tried at home earlier, they already have their own answers. They can check it with my answers. So friends, can I assume that you have tried this question 7 by 179? Right. So with this assumption, I am now reading the question because I had not read the question. So I will read the question now and then we will proceed further. So here is question number 7. A firm has rupees 10 lakh invested in its plant and sets a goal of 15% annual return on investment. So your goal is set as 15% return on investment, and investment is 10 lakh. 10 lakh into 15%, it means your targeted profit is 1,50,000, correct? Fixed cost in the factory presently amounts to rupees 4 lakh per year and variable cost is rupees 15 per unit produced. Now total fixed cost and per unit variable cost remains constant. In the past year, the firm produced and sold. 50,000 units at rupees 25 each. So last year you have sold 50,000 units at a selling price of rupees 25 and earned a profit of rupees 1 lakh. So by selling at 25 rupees, you could earn a profit of rupees 1 lakh. Now we can cross check this profit of 1 lakh. How? Check this 25 rupees selling price minus 15 rupees variable cost. So your contribution per unit will be 10 rupees. 10 rupees per unit into 50,000 units sold last year. So 10 rupees contribution per unit into 50,000 units sold, total contribution will be 5 lakhs, correct? 5 lakh contribution minus this 4 lakh fixed cost. 5 lakh contribution minus 4 lakh fixed cost, your profit will tally 1 lakh with the data given. Now the important thing is, how can management achieve their target profit goal? What was the target goal? to generate 15% return on 10 lakh investment. It means target profit was 1,50,000, but you have earned only 1 lakh and target was 1,50,000. Now the question is, how can management achieve that target profit goal? By varying different variables like fixed cost, variable cost, quantity sold, or increasing the price per unit. Now this question or this sentence requires interpretation. Last year you have achieved a profitability of 1 lakh, but you are away from the target. Your target profit is 1,50,000. Now question is saying how you can achieve that goal, means how you can move from 1 lakh to 1,50,000 by varying a different variables. By varying means by changing. So you have to make some changes in those variables. And in which variables? Variables like fixed cost. Variables is a statistical term, mathematical term. The value which changes can be called variable, right? Variables are attributes you must have studied in statistics, right? Variable can be measured. Attributes means qualities which are difficult to measure, like honesty is an attribute which is difficult to measure. But height of a person can be measured because height is a variable, weight is variable. But honesty, sincerity, these are difficult things to measure. So these are called attributes in statistics. Anyway, I am just saying varying a different variables. Varying a different variables means one, fixed cost. Means you have to make changes in fixed cost, so much change that you can achieve the target goal. Then you have to make another change in variable cost, so much change that you will achieve the target goal. Then change in quantity sold, by how much quantity sold should change so that I can achieve the target profit goal. And increasing the price means by how much I should increase the sales price. So simply speaking, you have to increase the profit. To increase the profit, either decrease the cost. Cost has to be decreased to increase the profit, or quantity sold should increase to increase the profit, or selling price should increase to increase the profit. That is the logic. And you have to increase the profit by how much? By 50,000, because your target profit goal is 1,50,000 and actual profit of last year is 1 lakh. So you have to increase the profit by 50,000. How this 50,000 increase in profit can be achieved? By changing one variable at a time. Now this I am saying one variable at a time because you have to give these changes for 4 variables by changing different variables. But different variables means one at a time, not all at a time. So make only one change at a time, other figures will remain same. So I have to only change fixed cost and see how I can achieve the target profit goal. Are you getting it? Then I have to change only variable cost and see how I can achieve the target profit goal. So there will be 4 answers for 4 variables, one variable at a time. So you will change one variable at a time to achieve the target profit goal. I hope I have made the question clear. It must have already been clear to you based on your own reading. Now we will go to the fair solution. So start writing the solution. Start writing the solution, fair solution. Write down question 7 by 179. Question 7 by 179. Write down target profit. Target profit. Calculation. This 10 lakh is investment and 15% is return on investment. So 10 lakh into 15% is equal to 1,50,000. 10 lakh into 15% is equal to 1,50,000 less last year's profit, less last year's profit 1 lakh, less last year's profit 1 lakh. Therefore, desired increase in profit, right? You have to increase the profit by how much? 50,000 so that you can achieve the goal. So desired increase in profit is 50,000. Now below write down a sentence. The management of the company, can achieve target profit goal the management of the company can achieve target profit goal by changing following variables by changing following variables one at a time. By changing following variables one at a time as follows. By changing following variables one at a time as follows. So we'll go one by one. Point number A, write down fixed cost. Point number A, fixed cost. Naturally, the answer is just one line. It should be reduced by rupees 50,000. It should be reduced by rupees 50,000. Answer is so simple if you interpret the question. Now, are you still surprised? If I reduce the fixed cost by 50,000, will I be able to achieve the target profit goal? Yes. Cost has to be reduced to achieve the target profit goal. Now, all other variables will remain the same. Only fixed cost given to you in the question is 4 lakh. If this 4 lakh fixed cost is reduced by 50,000, then it will become how much? After reducing it by 50,000, it will become 3,50,000. Can I achieve the target profit goal then? How? Your contribution per unit is 10 rupees. Number of units sold are 50,000. 50,000 into 10, 5 lakh is the contribution. 5 lakh contribution minus fixed cost 3,50,000. This is how your target profit goal will be achieved. So you can yourself verify, but make only one change at a time. Now when I am going to second part of the question, fixed cost will come back to normal. Only have to make one change in the variable cost. Now you must have started thinking. If not thought earlier, then you will start thinking now. Point number B, write down variable cost. Point number B, variable cost. Now my dear friends, our total variable cost should decrease by how much? 50,000 only, no? If cost reduces, profit increases. Total variable cost should decrease by 50,000 rupees. But variable cost is better expressed on per unit basis and fixed cost is better expressed on total basis. So 50,000 I have to reduce the variable cost over 50,000 units. Last year I have produced and sold how many units? 50,000. So 50,000 rupees reduction over 50,000 units means rupee 1 per unit reduction. So write down, reduction of rupee 1 per unit is required. Reduction of rupee 1 per unit is required. How it is calculated? That is rupees 50,000 divided by 50,000 units. Rupees 50,000 divided by 50,000 units. That is rupee 1 per unit. That is rupee 1 per unit. Now if you still want to verify how it will be, we can cross check. Selling price is given to you as 25. Variable cost given to you in the question is 15 rupees. 15 rupees. We will reduce it by 1 rupee. So your variable cost will now become 14 rupees, correct? Your contribution will become 11 rupees into 50,000 units. All other data will remain the same. We have only made this change. There is change only in variable cost. All other data same. This will become 5,50,000 minus fixed cost is 4 lakh. Fixed cost will remain now original, which is given. You can achieve a target profit of 1,50,000. You can cross check the answer on your own. So just reduce the variable cost by rupee 1 per unit and you can achieve it. Third is C, quantity sold. Point number C, quantity sold. Now naturally sales quantity has to be increased. Sales quantity has to be increased, but then by how much? And sometimes I get two answers from the students, right? Sometimes I get two answers from the students for quantity sold. My dear friends, quantity sold should increase by 5,000 units. How much? I said 5,000 units. Now one more view is, sir, it should increase only by 2,000 units. Now how 2,000 answer is given by people? That 50,000 increase in sales divided by 25 rupees selling price. So some people say increase it by 2,000. Quantity sold should go up by 2,000. But my dear friends, if number of units increases, don't you think variable cost will also increase with increase in number of units? Because variable cost varies depending upon number of units. So what you have to do is, see, 25 rupees is selling price minus 15 rupees is variable cost. With each unit sold of 25 rupees, your variable cost will also increase by 15 rupees for every unit. It means on every unit you will be able to earn a contribution of only 10 rupees. Understand, if I sell one unit for 25 rupees, one unit more of 25 rupees, 15 rupees cost also will be incurred, variable cost. So what will remain in my pocket is only 10 rupees. So on every unit sold, I will earn only 10 rupees. And I want to increase my earning by how much? 50,000. So 50,000 divided by 10 I have to do. So correct answer is 5,000 units and not this, not 2,000 units. Are you getting the point? If you increase the sales quantity by 2,000 units, your sales revenue will increase by 50,000. 2,000 units into 25 rupees, your sales revenue will increase, not profit. Are you getting my point? Your revenue will increase by 50,000, not profit, because your cost will also increase by 2,000 into 15 rupees, variable cost also. So your profit won't increase by 50,000. To increase the profit by 50,000, you have to divide this 50,000 rupees by contribution per unit, that is by 10 rupees. Anyway, write down the answer. It should be increased by 5,000 units. It should be increased by 5,000 units. Quantity sold should be increased by 5,000 units. That is desired increase in profit. Calculation also will write down. That is desired increase in profit divided by contribution per unit. Desired increase in profit divided by contribution per unit. That is 50,000 divided by 50,000 divided by, in the denominator you will write 25 minus 15. That is 5,000 units. That is 5,000 units. And this can be cross-checked, my dear friend. You can also cross-check on your own. How you can cross-check? We are just increasing the quantity sold. So your contribution per unit will remain 10 rupees. Contribution per unit. Into quantity sold, which was earlier 50,000 units, now will become 55,000 units. So quantity sold will become 55,000 units. So you will get total contribution. Total contribution 5,50,000 minus fixed cost 4 lakh. And you will get your desired profit 1,50,000. Got it? So it can be cross-checked, no? If your answer is 2,000 units, you can cross-check whether at 2,000 units you are able to achieve the desired profit or not. And one more is left. You have to increase the sales price. So point number D, sales price. Now sales price has to be increased, no? Because profit has to be increased. So there has to be increase in sales price. Increase in sales price by 1 rupee. Why? Total profit increase required is 50,000 divided by 50,000 units. See, by increasing the sales price, variable cost will not increase. Variable cost will increase only with increase in quantity, not with increase in sales price. So whatever is the increase in sales price, same is the increase in profit. So write down, increase the sales price by rupee 1 per unit. Increase the sales price by rupee 1 per unit. How it is calculated? That is rupees 50,000 divided by 50,000 units. Rupees 50,000 divided by 50,000 units. That is rupee 1 per unit. Now we can cross check this if you want. How? Whether this is correct or not. Your selling price earlier was 25 rupees. Now we have increased the sales price by 1 rupee. So now it will become 26 rupees. However, variable cost per unit will remain same, 15 rupees. So contribution per unit will become 11 into quantity sold same, that is 50,000. Your total contribution will become 5,50,000 minus fixed cost 4 lakh. Correct? And you will get your desired profit 1,50,000. So much explanation I am giving just to make you comfortable, right? That the answers calculated are correct. Okay friends, let's move further. Another interesting question, logical question, question number 8. Question number 8, page number 180. So I'll take you to the question. Question number 8. A, B and C are three similar plants Those are plant and machineries, right? Not products. There are three similar plants under the same management who wants them to be merged for better operations. So there are three plants and management wants to merge them together for better operation. The details are as under plant A, plant B, plant C. I am repetitively saying it is not product A, product B, product C. Product is same, whatever it is, manufactured by all the three plants. So there are three different plant and machineries. The capacity at which these plants are operating, A is operating at 100% capacity, B operates at 70% capacity, C is operating at 50% capacity. Remaining data is in rupees lakhs. The turnover, that is sales, is given in rupees lakhs for all the three plants. Please remember this turnover is at 100%, 70% and 50% of the capacity. Then variable cost is given and fixed cost is given. Sales given, that is turnover, variable cost, fixed cost. Question is, find out, number 1, the capacity of the merged plant for break even. Means you have to calculate at what percentage capacity you will be able to achieve break even point for merged plant. Means all the three plants merged together. Management wants to merge them together. So after merging the three plants A, B and C together, at what percentage capacity you will be able to achieve break even point. Second question is, the profit at 75% capacity of the merged plant. Means suppose if your merged plant operates at 75% capacity, then how much profit do you expect if your merged plant operates at 75% capacity? And third question is the turnover from the merged plant to give a profit of 28 lakhs. Means if your desired profit is 28 lakhs, then to earn that 28 lakh rupees profit, your merged plant should operate at what turnover level? Means what should be the turnover, that is sales, generated by a merged plant to achieve the profit of 28 lakhs. So first answer is asked in capacity, that is percentage. Second answer is calculation of profit. Third answer is calculation of turnover. But all the three answers are required for a merged plant. It means first we have to merge the data. I have to merge the data of plant 1, 2 and 3 and I have to calculate this total data or merged data. Just think over a little how to merge the data. Thought of? Okay. I'll just take you here. Suppose if I add the turnover to calculate the turnover of merged plant, it means if I take this 300 plus 280 plus 150, how much you get? 300 plus 280 plus 150. Okay. How much you get the sales? 730. 730 will be the turnover of merged plant. But this 730 will be the turnover of merged plant at what capacity? Can you give me this answer? At what capacity? 730 will be the turnover of merged plant at what capacity? Because capacity of individual plant is different. The capacity at which it is operating is different. So some of you may suggest, sir, take this total 100% plus 70% plus 50%, right? 100 plus 70 plus 50, it becomes, is it 220%? Is it correct? Can I say at 220% capacity of the merged plant that sales turnover will be 730 lakhs? Is it correct? Naturally not. If this way of thinking is incorrect. Now the trick lies, to merge this, the trick lies all the three plants should be converted to same capacity operated before merging. Means before you merge the data, bring the data at same platform. Meaning, okay, I'll just tell you what to do. What I have explained you was wrong. But that might be the way of thinking. Some of you might be thinking in that way. You cannot simply add them. Because you cannot add this 100% with 70% with 50%. See, either convert the data of all the three plants at 100%, 100%, 100%, then add them together. If you add them together, then you will get the capacity of merged plant at 100% only. 100% of merged plant, not 300%. But you have to add 100 with 100 with 100%. Or you add 70% capacity of plant A with 70% B and 70% capacity C. Then you will get merged plant capacity at 70%. Are you getting it? Or convert all the three at 50%, 50%, 50% and then add them together. You will get the data of merged plant at 50% capacity. Simply speaking, the only trick lies in this question is bring the data at par before merging. That's all. That's all. And you do whatever way you like, your answer will be correct. Now what I am going to do to solve this question, plant A is already at 100%. I will convert this plant B data from 70% to 100%. I will convert plant C data from 50% to 100% and then I will merge. So I will get 100% capacity of merged plant. 100% capacity of merged plant, not 300% capacity. But that is the only trick. I will write this approach and then we'll write the answer. Before that, I'll just take one more example to explain, just for example's sake. Suppose we have got classroom number 1. Classroom number 1 is a smaller classroom. It has a capacity to accommodate 50 students, but this is 100% capacity to accommodate 50 students. Just assume. And there is an adjacent classroom which is a bigger one. It's a bigger classroom number 2, but the 100% capacity, full capacity of this classroom is to accommodate 150 students. If I merge these two classrooms, if I remove the wall in between and merge these two classrooms, the merged classroom will have the capacity of how much? The merged classroom will have a capacity of 50 plus 150, 200 students at 100% capacity, no? The merged classroom's full capacity will be 200 students, 50 plus 150, isn't it? Or will I say the merged classroom's 200% capacity is 200 students? No, it's 100% capacity of merged classroom. Okay. Now, can you add this? If I take this 50% capacity of this classroom, that is 25 students. And if I take 100% capacity of classroom number 2, that is 150 students, can I add these two together? 25 and 150. Because this is at 50% and this is at 100%. We cannot add. So the only trick I said, just before merging, bring the data at same level and then get the answer. Answers are very easy now. Only that concept is important. So let's write down the fair answer now. Fair answer, question number 8 by 180. Fair answer, question 8 by 180. First write down the approach. This is for you to refer in future. Approach to solve this question. Approach to solve this question, comma, we need to convert the data. We need to convert the data of all the three plants. We need to convert the data of all the three plants at a uniform capacity level. We need to convert the data of all the three plants at a uniform capacity level. Written? Okay. Below write down number 1. Number 1, revenue and cost data. Number 1, revenue and cost data of merged plant. Revenue and cost data of merged plant at 100% capacity level. Revenue and cost data of merged plant at 100% capacity level and BEP. Revenue and cost data of merged plant, we are doing it at 100% capacity level and will also calculate BEP. Figures in rupees lakhs. Right hand side write down figures in rupees lakhs because data given to you in the question is in rupees lakhs. Okay, prepare the columns like this: particulars, plant A, plant B, plant C, and total. Total column is your merged plant. So particulars in 4 columns, around 10 lines, vertical. Particulars 4 columns, plant A, plant B, plant C, and total. And vertical around 4 lines. Ready? Point number A, turnover. If you are ready with the format, particulars 4 columns, right? Point number A, turnover. Now I will take you back to the question. See, the turnover of plant A is already at 100%, so I don't have to convert. But B I have to convert. If 280 lakhs is the turnover at 70%, what will be the turnover at 100%? How you will get that? 280 divided by 70%. If 150 lakhs is the turnover at 50%, then what will be the turnover at 100%? Naturally, it will be double, that is 300. So you have to convert all the data to 100%. Similarly, variable cost will also change with change in capacity utilization. So you have to convert this variable cost 210 divided by 70%, 75 divided by 50% to convert it into 100%. However, please remember, fixed cost will remain same because fixed cost from 0% to 100% capacity utilization remains constant. You operate at any level of activity, but fixed cost will remain same. So fixed cost you will copy as it is. Are you getting it? Sales and variable cost you will convert to 100%. Fixed cost will remain same irrespective of level of capacity used. So write down turnover 300. For plant B, what you have done? 280 divided by 70% is 400. Please remember, all this data is now at 100%. And plant C will become 300. Now you can take the total. Now the total is logical. Earlier total was illogical. So now the total is 1000 lakhs. It means if you operate the merged plant at 100% capacity, then the turnover would be 1000 lakhs. That is the meaning. B, variable cost. B, variable cost 200, 300, 150, total 650. Total 650. I will calculate contribution also because we will need it for solving. So contribution, point number C, contribution A minus B, contribution A minus B, that is 100, 100, 150, total is 350. Total is 350. So if you operate your plant, merged plant at 100% capacity, you will be able to earn a contribution of 350 lakhs. D, fixed cost, write down no change. Fixed cost no change because fixed cost remains constant for that period irrespective of production capacity. Fixed cost as it is copied 70, 50, 62. But you have to add them for merged plant. Like I have to add the rent of classroom 1 and classroom 2 and I have to pay total rent now. Rent is a fixed cost. So similar to that, these 3 plants have got their individual fixed cost which you have to add and you will get 182. So 182 will be the total fixed cost for merged plant whether you operate at 1% capacity or whether you operate at 100% capacity. Point number E, overall PV ratio. Overall means for merged plant. Overall PV ratio. Overall PV ratio is C divided by A. C divided by A, that is this contribution of merged plant divided by turnover of merged plant. 350 divided by 1000. So you will get it as 35%, right, only in the total column. Because we want the data of merged plant. All the 3 questions asked are related to merged plant. So this is 35%. Now point number F, contribution at 1% capacity. Write down contribution at 1% capacity. Now why we are calculating contribution at 1% capacity? Because we have to calculate BP in capacity. Check first question, you are asked to calculate BP capacity. So I will need contribution at 1% capacity. How will get it? Very simple. See, this is the contribution at 100% capacity. So 350 divided by 100, 3.5. Just write down 3.5. If you know the contribution at 100% capacity, what will be at 1%? 3.5. And now to calculate BP in capacity, what you will do? Fixed cost divided by contribution at 1% capacity. Fixed cost divided by contribution at 1% capacity, you will get BP in percentage capacity. So point number G, BP capacity. BP capacity is D divided by F. BP capacity is D divided by F. 180 divided by 3.5. Oh, sorry, 182 divided by 3.5. So you'll get 52%. 52%. So you can achieve BP at 52% capacity of merged plant. Is that clear? Now another way of doing it, see, is mathematics. There could be n number of ways to do it. You can first calculate BP in turnover, that is rupees sales, and then convert it into percentage. How? Check this, fixed cost divided by PV ratio, that is 182 divided by 35%. How much you get? 520. 520 lakhs will be BP sales, and this BP sales divided by this 1000 is at 100% capacity. So 520 out of 1000 is how much percentage? 52% capacity. Same answer. This way also you can do. Got it? But if you know the direct formula, you will directly get the BPS capacity. Otherwise, first calculate in sales, BP sales, and convert that sales into percentage capacity. Now remaining answers would be very simple. How? Let me tell you. What is the second part of the question? Profit at 75% capacity of merged plant. Okay, profit is asked. How I can do it? See, this is the contribution at 100%. I will take only 75% contribution. If I know the contribution at 100% capacity, I will easily get contribution at 75% capacity minus fixed cost. That's all. You will get profit. We will be writing that. I will discuss third question also. Third question is turnover required for merged plant to earn a profit of 28 lakhs. Correct? So desired profit 28 lakhs, desired profit plus this fixed cost 182, desired profit plus fixed cost divided by PV ratio. V ratio is ready. You will get the turnover required to earn the desired profit. So very simple. Write down the remaining answers now. Number 2. Profit at 75% capacity of merged plant. Profit at 75% capacity of merged plant. Write down is equal to 75% of total contribution. 75% of total contribution minus fixed cost. %75 of total contribution minus fixed cost is equal to 75 into 350 lakhs. 75% into 350 lakhs minus 182 lakhs. So 75% of 350 minus 182 directly on the calculator, you will get rupees 80.5 lakhs. 80.5 lakhs is your profit. Correct? I hope most of you are doing the calculation ahead of me. Means you are ahead, I am behind. That is always good for your health. If you are left behind me, then it is not good. Number 3, turnover required to achieve profit of rupees 28 lakhs. Turnover required to achieve profit of rupees 28 lakhs. is equal to numerator desired profit plus fixed cost, numerator desired profit plus fixed cost divided by PV ratio, desired profit plus fixed cost divided by PV ratio is equal to desired profit 28 lakh plus fixed cost 182 lakh. So numerator 28 plus 182 lakh divided by 35%. Divided by 35%. So you get the answer as 600 lakhs. Right? 600 lakhs is the turnover from merged plant to earn a profit of rupees 28 lakh. Interesting questions, my dear friends. I am repetitively saying calculation part is very simple. Calculation will hardly take any time. You have to read and interpret the question correctly. My major focus, you would have understood by now, right? Today is the third lecture. That main focus is on correctly interpreting the question, finding the approach to solve. Actually solving the question takes hardly any time. Once it clicks to your mind what is to be done, just on calculator also you can get the answer. Simply on calculator even without writing. But from exam point of view, you have to write down everything to get the marks. Therefore, I am making you write also. But more important is that approach, thinking, interpretation of question. And this is the way we will proceed for the whole journey. Right? For the whole journey, main part is reading and interpreting the questions. We go to question number 9 now. Another interesting question. Right? Those who have already tried it yesterday, right? Must have enjoyed this question number 9, right? Others, those who want to try, naturally the option is pause the video, try on rough paper, again check with my answer by playing the video again. Okay, I'll take you to question number 9. Question is small in size but very interesting. Number 9. A company has an opening stock of 6,000 units of output. Opening stock, please remember. The production planned for the current period is 24,000 units. You are planning to produce 24,000 units more. 6,000 units are already in stock. 24,000 you are planning to produce, means total available goods for sale will be 30,000. Its expected sales for current period amounts to 28,000 units. Right? Your expected sales is 28,000 units. So from 30,000, if you sell 28,000, 2,000 will be closing stock, correct? The selling price per unit of output is rupees 10. This is your selling price. Variable cost per unit is expected to be rupees 6 per unit, while it was rupees 5 per unit during the previous period. In current period, your variable cost is expected to be 6 rupees, whereas last year's variable cost was 5 per unit. So variable cost was different last year, different this year. Now total fixed cost for the current period is 86,000. Your current period's fixed cost is 86,000. The question is, calculate break-even volume in units, break-even in units, and also margin of safety in units using FIFO, LIFO and weighted average cost method. This is very interesting. You have studied FIFO, LIFO average in stores ledger, CA intermediate, if you remember. FIFO, LIFO average are the method of valuation of stock, inventory valuation methods. If I use this FIFO, LIFO average method here in marginal costing, to calculate BEP and margin of safety, I will get different answers depending upon different methods of valuation. And some of you must have already tried it. It's going to be very interesting calculation. It's going to be very interesting calculation, right? As I am assuming that you have already read the question, you have already tried, I am directly taking you to the solution. So I am directly discussing the solution now. First of all, in order to calculate BEP, one mistake is likely to take place, and that is, in order to calculate BEP, you don't need this expected sales in the current period. This figure is of no use. 28,000 units is of no use. Now some of you will say why? My dear friends, whether you sell 28,000 units, you sell 2,000 units, you sell 20,000 units, BP is not going to change. BP will remain where it is. For example, in the examination, C examination, your BP marks are 50%. Your actual score may be above 50% or below 50%. BP will remain at 50% only. So to calculate BP, even otherwise you don't need actual sales, no, for calculation of BP. Generally BP in units we calculate as fixed cost divided by, contribution per unit. Where I have given you the figure of actual sales then? Just fixed cost divided by contribution per unit will give you how many units we should sell to achieve BP. Now actual sales is required only for margin of safety. If your actual sales is above BP, then you are having margin of safety. If your actual sales is below BP, then you don't have margin of safety. On the contrary, you are in losses. So actual sales or expected sales figure is required only for margin of safety, not for calculation of BP. That one thing is very clear. Those who have tried BP using 28,000 units is of no use. You will go wrong. So ignore 28,000 units for BP calculation. It is useful only for margin of safety calculation. Now, how will you use FIFO leaf average? It's very simple once understood. Some of you must have already got the correct answer. Now see, variable cost last year was 5 rupees. And the goods produced last year but remaining unsold is carried to current period. That will become opening stock. It means this opening stock of 6,000 units, if it is opening stock, it was produced last year. Naturally, produced last year, remained unsold, carried to current year. So 6,000 units of opening stock are having a variable cost of 5 rupees. And the current production of 24,000 units will have a variable cost of 6 rupees per unit. Current production will be at current variable cost, and earlier production is at earlier variable cost, which is carried to current period. So 6,000 units of opening stock is having 5 rupees variable cost, and 24,000 units expected to be produced in the current period will have a variable cost of 6 rupees. But all these units will be sold at what price? Selling price is uniform, selling price is 10 rupees. Using this data and using fixed cost, we will get BP. So I'll take you to the answer, and you will find the answer is very simple. You will write the answer also with me. Write down. This was the slide I had prepared for noting your answer, right? Whatever answer you have calculated, you must have noted somewhere, right? In your notebook or on rough pages you have already noted. Now compare your answers later on with my answers. So I am taking you ahead. This is just to note down your answers of BP. Okay, we'll go to the fair solution. Write down question 9 by 180. Question 9 by 180, key data. So whatever data is given in the question, I am copying it in a tabular format. So write down key data given and prepare these columns: particulars, units, selling price per unit, variable cost per unit, and contribution per unit. And just 4 lines. Key data given, particulars in 4 columns. Particulars in 4 columns, that is units, that is number of units, selling price per unit, variable cost per unit, and contribution per unit. Done. Just 4 lines. Vertical lines are 4. Okay, start writing. Opening stock. Opening stock, how many units you have? 6,000 units. If you sell them in the current period, what is the current period? Is the sales price? 10 rupees. So 10 rupees is the selling price. Now how customer will come to know that it is last year's stock, so it should be sold at a different price? Price will be, for current period, price is 10 rupees, whether you sell out of opening or out of current production, it doesn't matter to the customer. But variable cost for you, you know that it was last year's stock and the variable cost was only 5 rupees. So if you sell these 6,000 units, your contribution per unit will be 5 rupees, that is 10 minus 5, because your cost of production was lower in the last year. And production, that is current production is 24,000 units. Current production is 24,000 units. This also you will sell at 10 rupees, but the variable cost for these units is expected to be 6 rupees. I hope you are writing. And 10 minus 6, contribution per unit will be 4. 10 minus 6, contribution per unit will be 4. I have done nothing. I have just copied the data given in the paragraph in a tabular format for simplicity purpose, for simplicity of calculation. I am writing one more figure that is important. Write down total fixed cost 86,000. Total fixed cost 86,000. This is important. Why? See, to achieve BEP, you have to recover this fixed cost, no? To achieve break-even point, you have to recover fixed cost, that is 86,000. Okay, now I'll discuss the answer right now before writing the fair answer. I'll just discuss. First in, first out means what? Based on your intermediate experience, first in, first out means you will first sell these units, and thereafter, after finishing these 6,000, then you will sell these units, correct? That is first in, first out. If you go by last in, first out, then you will sell these units first, and then if required, you will touch these units, correct? Last in, first out. And weighted average means you have to do the averaging of these entire 30,000 units and then calculate BEP, correct? Now, check. Pay attention to the discussion, then write. You will get the time to write. I am using FIFO method, first in, first out. Now, to achieve BEP, I need to earn just sufficient contribution to recover this fixed cost. That is, I want to recover the fixed cost of 86,000 using FIFO method. So, using FIFO method, I will first sell 6,000 units and I will earn a contribution of 5 per unit. 6,000 into 5, how much contribution I will be able to earn? 30,000. So 30,000 contribution is earned, which has recovered my fixed cost partially. Now from 86,000 fixed cost, 30,000 is recovered by selling 6,000 units out of opening stock. First in, first out. How much fixed cost is left to be recovered? 56,000 fixed cost is yet to be recovered. So have I achieved BEP now? No. It is by selling 6,000 units I am unable to achieve BEP. There is unrecovered fixed cost of 56,000. Now to recover this 56,000 fixed cost, I have to sell the units out of current production. I have to sell the units out of current production. But how many units I should sell out of current production to recover that remaining 56,000 fixed cost? From current production, my contribution is 4 per unit. So 56,000 divided by 4. 56,000 divided by 4. I have to sell 14,000 units more. Out of current production, I have to sell 14,000 units more to recover the remaining fixed cost. It means if I use FIFO method, I have to sell these 6,000 units from opening stock, plus I have to sell 14,000 units from current production. It means I will have to sell total 20,000 units, correct? Out of 20,000 units, first I will sell opening stock of 6,000 units, and then remaining units I will sell out of current production. If I sell 20,000 units on FIFO basis, I will be able to recover my entire fixed cost of 86,000. It means my BEP is 20,000 units. It was so simple. And expected sales is how much? 28,000. So 28,000 minus 20,000 BEP, remaining 8,000 extra sales is my margin of safety. Got it? Similarly, we have to do calculations for all. Got it? Write down. BEP using FIFO method. Write down the fair answer. BEP using FIFO method. Below write down required contribution, that is fixed cost. Right? Required contribution or your desired contribution, that is fixed cost, is 86,000 less contribution from opening stock, less contribution from opening stock, that is 6,000 units into 5, 6,000 units into rupees 5 per unit, that is 30,000. Therefore, balance contribution required is 56,000. Balance contribution required is 56,000. Written. Below written, quantity to be sold from current production. Quantity to be sold from current production is equal to 56,000 divided by 4, is equal to 56,000 divided by 4. Is equal to 14,000 units. Please remember, answer is not 14,000 units. 14,000 is from current production after selling 6,000 from opening. So it is 6 plus 14. Total BEP units is equal to, total BEP units is equal to 6,000 plus 14,000 is equal to 20,000 units. And question was asked in units, BEP in units, MOS in units. So we are calculating the answer in units. And margin of safety units is equal to, margin of safety units is equal to total sales minus BEP sales. Total sales minus BEP sales is equal to 28,000 minus 20,000. 28,000 minus 20,000, that is 8,000 units. That is 8,000 units. Done. I'll discuss LIFO also and weighted average also. So I'll just discuss it from our key data. Okay, so I'll take you back to the key data. If you have noted this down. So this was your key data. Now I will go by LIFO method. In LIFO method, first I will use these units. And if these units are insufficient to achieve BEP, then I will sell out of opening. Correct? Now my fixed cost is 86,000. 86,000 divided by this 4 rupees contribution. How much I get? 86,000 divided by 4. So it comes to 21,500 units. Can I sell 21,500 units out of 24,000 units? Yes, very easily I can sell 21,500 units out of 24,000 units. So I got my BEP. I got my BEP in first stroke. See, if this answer exceeds 24,000 units, then to earn balance contribution, I have to sell these units, opening stock. Only if my current production units are insufficient, then I have to touch opening stock, otherwise not. So in one stroke I will get BEP, that is just 86,000 divided by 4. That is last in first out, LIFO method. And for average, what we have to do? For average, we have to calculate a weighted average contribution, that is 6,000 units into 5 rupees. I'll get total contribution. Then 24,000 into 4 rupees. I will add in the numerator total contribution divided by total quantity. Total quantity is 6,000 plus 24,000, that is divided by 30,000 units. So by doing this, I will get weighted average contribution per unit of entire quantity. And then 86,000 divided by weighted average contribution per unit, I will get BEP. That will be using weighted average method. Is that clear to you? So let's write down the remaining answer. First we'll write LIFO answer. So write down BEP using LIFO method. BEP using LIFO method. Write down required contribution, that is fixed cost. Required contribution, that is fixed cost, is 86,000. Below write down BEP in units is equal to BP in units is equal to 86,000 divided by 4. 86,000 divided by 4 is equal to 21,500 units. 21,500 units from current production. 21,500 units from current production. Below you will write a sentence. As current production of 24,000 units, as current production of 24,000 units is sufficient, as current production of 24,000 units is sufficient to cover 21,500 units, is sufficient to cover 21,500 units, comma, this itself is the answer. This itself is the answer. So naturally one question will be there in your mind. Sir, suppose if this is insufficient, then what? Then I already told you, then we'll have to sell the units from opening stock also. I'll give you that calculation also, extra calculation. First write down margin of safety. MOS units is equal to 28,000 minus 21,500. 28,000 minus 21,500 is equal to 6,500 units. Is equal to 6,500 units. This is your answer of this question. Now I'll do some extra calculation. Okay. Below write down extra working. Extra working. This is not part of the answer because it is not asked in the question. I am doing some extra working. What I am doing? I am changing the fixed cost. I am increasing the fixed cost so much that your current production 24,000 units will become insufficient. And if they are insufficient, then you'll have to sell out of opening also. So just to give you that idea, because leaf answer you got in just one stroke, but it can, in a situation, it may take 2 steps also. For example, just a minute. Suppose my fixed cost is 1 lakh. Can I earn 1 lakh contribution by selling 24,000 units? No. Right? My 24,000 units will give me a contribution at the rate of 4 per unit. I think that is 96,000 it will be. Correct? 96,000. So my remaining contribution, unrecovered fixed cost is how much? 4,000. And to recover this 4,000 remaining fixed cost, I have to go to opening stock. And on opening stock, I am earning 5 rupees contribution. So 4,000 divided by 5. I'll have to sell 800 units more out of opening stock. It means in that case BP will be this 24,000 units from current production plus 800 units from opening stock. Your BP will be 24,800 units. If my fixed cost is 1 lakh, then I'll give you this also in writing, but you will write it as extra working. Write it as extra working because I have seen if students don't write this sentence, later on they ask me question, sir, where is this 1 lakh has come from? Because 1 lakh is fixed cost is not given in the question. I have assumed it just for explanation purpose, just for conceptual clarity purpose. So better you write that sentence extra working. Below write down, if we assume that fixed cost is rupees 1 lakh, if we assume that fixed cost is rupees 1 lakh instead of 86,000, if we assume that fixed cost is rupees 1 lakh instead of 86,000, then the BP using LIFO method shall be, then the BP using LIFO method shall be written below. Write down 24,000 units from current production, 24,000 units from current production will generate a contribution of rupees 96,000. Will generate a contribution of rupees 96,000. Show the working in the bracket, that is 24,000 into 4. That is 24,000 into 4. And for balance rupees 4,000 contribution, we need 800 units. We need 800 units from opening stock. We need 800 units from opening stock. And how this 800 is calculated? In the bracket write down, that is 4,000 divided by 5. 4,000 divided by 5. Next line, BP is equal to 24,000 plus 800 units. BP is equal to 24,000 plus 800 units is equal to 24,800 units. Is equal to 24,800 units. Okay. Done. So this was the extra answer. Actually, our answer was 21,500, which we got in one stroke only. Now we have to do that weighted average. So write down BP using weighted average method. BP using weighted average method. Below write down weighted average contribution per unit. Weighted average contribution per unit. Is equal to, calculate this weighted average contribution per unit is equal to numerator in one bracket 6,000 into 5. 6,000 into 5 plus another bracket 24,000 into 4. I have already explained this to you. 6,000 into 5, one bracket plus 24,000 into 4 divided by 6,000 plus 24,000. Divided by 6,000 plus 24,000. Right? You are the mathematics students, you know how to calculate weighted average. Therefore, I said basic mathematics is required. Do it. Use the calculator, my dear friends. So it is numerator is 30,000 plus 96,000 divided by total units 30,000. Calculation part you should be ahead of me. So it will be rupees 4.20 per unit, correct? Weighted average contribution is 4.20 per unit. Now just fixed cost divided by this. So you'll get BP in units is equal to 86,000 divided by 4.2. 86,000 divided by 4.2 is equal to, it is coming in fractions, I have written approximately by rounding it off to little higher side, 20,476 units approx. Right, approximately 20,476 units approx. I have rounded it up to the nearest, right, approximate answer. You can write 20,477 also if you want. So 20,476 units approx is the answer. Okay, I hope you have enjoyed this question, my dear friend. Once again, you will notice how much time is required for calculation. You can do it on the calculator also, as I said, right? This conceptual clarity I wanted, and that is the reason I am revising the intermediate level questions. Now we go to the next one. Okay, one more thing, margin of safety also write down please. MOS. MOS in units is equal to 28,000 minus 20,476. MOS answer is left. MOS is equal to 28,000 minus 20,476 is equal to 7,524 units. is equal to 7,524 units. Done? 7,524 units. I am on question 10. Now question 10 is also a tricky question. It's a little mathematics based question. Question 10 is little mathematics based. You have to interpret the question, apply the mathematical logic of your CA foundation, right? Because you'll have to solve some equation to get the answer. Would you like to try? Okay. Some of you must have already tried it, right? Some of you would like to try. So those who would like to try will use the pause button. Read the question first. I have not read. I have not yet interpreted, right? I am leaving it to you. You will read the question, you will interpret it on your own, and you will try on rough paper. Okay. So please try. I will give you the answer very soon. Friends, can I assume that you have tried question number 10? Right? Either you tried it yesterday at home, or my staff tried it now by pausing the video. Okay. So I'll do my duty now without wasting your time, because some people love that I should give time. Some people say no, it is wastage of time. You directly give us the answer. So I am reading the question 10 now, and then we'll go to the solution. So I'll just take you to the question. Question number 10, because I have not read it yet. The cost structure of an article, the selling price of which is 45,000, is as follows. Please remember, what is given to you is a structure of cost. Direct material is 50%, naturally 50% of total cost. Direct labor is 20% of total cost, and overheads is 30% of total cost. It is not the sales structure, it is the cost structure. Now why I am repetitively saying this? Some students make one mistake. What they do? Some students do the calculation, direct material cost is 50% of this. But 45,000 is sales, my dear friend. If you do 50% of sales, means you will consider this 50%, 20% and 30%. This becomes 100%. 100% of sales means your cost will become equal to sales. Then your profit will become zero. Are you getting it? So it is not the structure of sales, it is the structure of cost. So cost structure is, out of total cost, 50% is material, 20% is labor and 30% is overheads cost. That is how the composition of 100% cost is given. So do not calculate percentage of sales. This calculation will go wrong. Okay, we go ahead. An increase of 15% in cost of material and 25% in cost of labor is anticipated. You are anticipating 15% increase in material cost and 25% in labor cost. These increased costs in relation to present selling price. These increased cost in relation to present selling price is 45,000, would cause a 25% decrease in the amount of present profit per article. This sentence is important, requires careful interpretation. These increased cost in relation to present selling price means, if there is an increase in cost of material by 15% and 25% in labor cost with present selling price remaining same, naturally if cost goes up and your sales price remains the same, what will happen? Profit will decrease. So what is given is that this will cause a 25% decrease in present profit per article. Increase in cost will cause a decrease in present profit. Now you are required to, number one, prepare a statement of profit per article at present. First you have to prepare the profitability statement at present. How much profit you are earning per article, right? Data is given only for one unit only. And two, interesting question, the revised selling price. You have to calculate revised selling price to produce the same percentage of profit to sales as before. Now if you keep the sales price same, what will happen? Profit will come down. Now you have to calculate revised selling price, means naturally you have to increase the sales price. But you have to increase the sales price in such a manner that the percentage profit is maintained. The same profit percentage to sales which you are earning at present will be maintained with new selling price. So you have to give the new or revised selling price, because in future the cost is going to change. Right? I hope you had read this question, you had interpreted and you had tried to solve. Now we will go together. Right? The approach is, first our target will be to calculate present profit. What I'll assume this total cost as X. So I'll get material cost as 50% of X, that is 0.5X. I'll get labor cost as 0.2X. I'll get overheads cost as 0.3X. Correct? And sales price minus this cost, I will get present profit in terms of X. In terms of X. Now listen, important thing. We'll have to make a mathematical equation. Mathematical equation is increase in cost is equal to decrease in profit. See, if my sales price remains the same, whatever is my sales price, that is 45,000 given in the question. If my cost goes up by 1000 rupees, profit will decrease by 1000 rupees if selling price remaining the same. Naturally, by whatever cost increases, profit decreases. And from this logic, I will make an equation. I will make the equation of this 15% increase in cost and 25% increase in labor. This increase in cost will be equal to this decrease in present profit, 25% decrease in present profit. This equation I will solve to get the value of X. And the moment I get the value of X, naturally I will get the present profit. And then we'll discuss second part of the question, that by how much the sales price should be increased or what should be the revised selling price to generate same percentage profit. Let us solve first part of the question. Write down. Question 10 by 180. Write down. Let us assume total cost per unit is equal to rupees X. Let us assume total cost per unit is equal to rupees X. Written. So direct material is equal to 0.5X. Direct material is equal to 0.5X. Direct labor is equal to 0.2X. Direct labor is equal to 0.2X. Overheads is equal to 0.3X. Overheads is equal to 0.3X. Profit is equal to selling price minus cost. Actually, selling price minus total cost. So is equal to 45,000 minus X. Keep it as it is in the bracket, 45,000 minus X. Because we need to solve these equations. Because there is no other way of getting the solution. So this is your present profit in terms of X, right? And this is your present cost. Now, we'll enter into this equation. Write down. Increase in cost is equal to decrease in profit. Increase in cost is equal to decrease in profit. And now understand this mathematical equation carefully and then you will solve it. Check. Your material cost was 0.5x. This 0.5x is increasing by 15%. I am only taking the increase portion, right? So don't do 0.5x plus 15%, only into 15%, increase only. Increase in cost is decrease in profit. This labor cost 0.2x, this will increase by 25%. And this increase in cost will cause 25% decrease in this present profit. So this will be equal to 25% of the present profit, that is this profit. Okay. So prepare this equation and try to solve it. Get the answer. make the equation and solve it. I hope you are doing it. So you will definitely get the answer from my side also. I want you to try. Okay, it will be 0.075x plus 0.05x is equal to, if you solve the right hand side bracket, it will become 11,250 minus 0.25x. Simplify it further, get the value of x. You are very intelligent students of mathematics, studying since foundation stage. Right. Choice is yours. Either copy these steps from my screen or solve it on your own. Choice goes to you. Okay friends, almost all of you must have got the value of x as rupees 30,000. Value of x as rupees 30,000. Almost all of you must have got that answer. But what was x? X was just the total cost. I think the question number 1 is you have to prepare a profitability statement. So we'll prepare a detailed profitability statement where we'll write individual items of cost also, material, labor, overhead cost, and we'll deduct it from sales price to get the profit. So now I'm converting this data into a profitability statement. Okay. Right. So total cost is 30,000. That is the value of x. Write down number 1, first answer, statement of present profit. Statement of present profit, particulars, 2 columns, rupees, that is inner column and outer column. We'll write the breakup of cost in the inner column and then we'll take the total to the outer column. So particulars in 2 columns, rupees. Point number A, selling price. Selling price was already given to you, so I am writing it in the outer column, that is 45,000. Selling price 45,000. B, cost. We'll underline this word, cost. Now we'll write the breakup inner column, direct material. Right. Direct material is 50% of your total cost. So it is 0.5 into 30,000, that is 15,000. Direct labor. Direct labor 0.2 into 30,000, that is 20%, that is 6,000. And overheads. Overheads is 0.3 into 30,000, that is 9,000. Naturally, outer column total is 30,000 only. And A minus B, that is selling price minus cost, you will get profit. Point number C, profit, that is A minus B. Profit A minus B, that is 15,000. This is the answer of first question. First question was prepare the statement of profit per article at present. Right? At present you are earning 15,000. Now second question is interesting. So I will take you back to the second question. Now they are asking you to calculate revised sales price to maintain same percentage profit. See, maintaining same profit and maintaining same percentage profit is different. If the word is maintain same profit, then same profit means 15,000 profit. But they want you to maintain same percentage of profit. So we'll have to calculate the present profit as percentage of sales. And then we'll calculate revised cost. Revised cost after these increases 15% and 25% increase. So we'll calculate revised cost, and in that revised cost we'll add the percentage profit at same percentage and we'll get the revised sales price. Is that clear? Now check this. Your profit percentage is 15,000 upon 45,000 sales price. It means 1/3 of sales. This percentage profit is to be maintained. However, to solve the question, we don't know the sales price. We have to calculate the sales price. So instead of taking profit as percentage of sales, I will take it as percentage of cost. Right? That is 1/2 of cost, 15,000 upon 30,000. Earning profit 1/2 of cost is as good as 1/3 of sales. Both means one and the same. So let's write down the solution. Number 2, statement showing calculation of revised selling price. Statement showing calculation of revised selling price. Below write down earlier profit as percentage of sales. Earlier profit as percentage of sales is equal to 15,000 upon 45,000 is equal to 15,000 upon 45,000 is equal to 1/3 of sales is equal to 1/3 of sales, that is 1/2 of cost, is 1/3 of sales, that is 1/2 of cost. Below write down particulars rupees. Particulars rupees. Write down direct material. This is revised cost naturally to get the revised selling price. So direct material, your earlier cost 15,000 plus 15% increase. So 15,000 plus 15%. You get it as 17,250, correct? Then direct labor 6,000 plus 25%, 6,000 plus 25%, that is 7,500, correct? Now increase in cost was given only at two places, material and labor. For overheads, question is silent, so we'll assume overhead cost is same. So write down overheads. So in absence of information, we'll write assumed unchanged. So it will be same. Overheads assumed unchanged. So we'll keep it same as 9,000. So you'll get therefore revised total cost. Revised total cost is 33,750. Revised total cost is 33,750. Now to this I will add 1/2 of cost as profit. So add profit, half of cost, half of revised cost naturally. So 1/2 of 33,750, it comes to 16,875. 16,875. And cost plus profit you will get therefore revised selling price. Revised selling price. And revised selling price is 50,625. 50,625. Those students who got this answer earlier before I started discussing, very good, congratulations. Your interpretation is good, your mathematics is good. Those who got the answer before I started discussing the question, very nice, fantastic. Now those who want to check whether that profit ratio is maintained or not, it should be maintained at 1/3 of sales. Check, this relationship is 1/3 only. Calculate 1/3 of sales and you will get this profit. So your percentage profit is maintained, that is 33.33% if you want. So revised selling price will maintain the same percentage profit, and that is what you wanted. Now if the wording of the question would have been, I repeat, the wording of the question would have been to maintain same profit per article as present. Instead of percentage profit, the wording would have been to maintain same profit, then you would have just added here 15,000 because your present profit was 15,000. So the answer will change, that is 33,750 cost plus 15,000 same profit as earlier, and you will get the new selling price. So you will notice maintaining same profit per unit and maintaining same percentage profit, the interpretation is different and answer will be different. Anyway, correct answer was 50,625. Friends, we'll solve this one more question, that is number 11. So our basic questions will get finished today. Okay. Then we have to slowly move to decision making questions, right, of CA final level. So let us solve question number 11. I'll read question number 11. Question number 11. Even Keel Limited manufactures and sells a single product X whose selling price is rupees 40 per unit and variable cost is 16 per unit. So remaining is contribution. If fixed cost for this year are rupees 4,80,000 and annual sales are at 60% margin of safety, means your annual sales, whatever it is at 60% safety margin. Calculate the rate of net return on sales. Rate of net return on sales assuming income tax level of 40%. Assuming income tax level of 40%. Simply speaking, in this question, first of all, annual sales is missing. This is not known. But whatever is that annual sales, at that sales you are enjoying a 60% safety margin. And at that sales you have to calculate net rate of return. Now here the net word means, because income tax rate is given to you, here the meaning of net rate of return on sales is net profit after tax divided by sales into 100. It means you have to calculate the net profit after tax to sales ratio, means PAT, profit after tax, upon sales into 100. This is the answer they want. This is the answer of the question. You have to calculate this ratio. Now to calculate this ratio, I have to calculate profit after tax. Tax rate is fortunately given. Tax rates are very given on very low occasions or very rarely in costing. But if given, then you have to consider. So I have to calculate net profit after tax divided by sales and get the ratio. That's all. Question is simple, but you need to interpret it properly. How to reach to that annual sales, that is denominator and also the numerator, profit after tax. Now please remember what we will do. We will calculate PV ratio using selling price, variable cost, we will get contribution. From contribution we will get PV ratio. From PV ratio we will get BP sales, that is fixed cost, divided by PV ratio we will get BP sales. Now you will say BP is not asked. I know it is not asked. But please remember BP ratio and margin of safety ratio are complementary to each other. We have discussed this in the basic concepts. Means total of margin of safety ratio and BP ratio will be always 100%. I'll assume this annual sales as X. Of this, margin of safety is 60%. So BP is 40%. And we know that answer of BP. So whatever is BP we get, fixed cost divided by PV ratio, that is 40% of annual sales. So we'll get annual sales. Are you getting it? Because 60% is safety margin, your BP sales is 40% of annual sales. Once we get annual sales, we'll get profit after tax, and profit after tax divided by sales, you'll get the answer. So let's go, let's write it down. Write out the fair answer. Right? Some of you, those who have already tried it at home, will check it later on with my answer. Right? So your answer is at present question mark. It is with you, not with me. You will check it later. Okay. So I am taking you to the solution. Question number 11 by 180. Question 11 by 180. Even Keel Limited. Question 11 by 180. Even Keel Limited particulars rupees, particulars rupees, write down A, selling price per unit, A, selling price per unit, that is 40. B, variable cost per unit 16. C, contribution per unit, C, contribution per unit, A minus B, that is 24. D, PV ratio, PV ratio, C divided by A, PV ratio, C divided by A, that is 60%. E, fixed cost, fixed cost given to you is 4,80,000, and now fixed cost divided by PV ratio. So point number F, BP sales, BP sales, that is E divided by D, BP sales, E divided by D, that is 8 lakhs. Now friends, this is not the answer. This is the BP sales. We want annual sales, but this BP sales is 40% of your annual sales. So 40% of your X is equal to 8 lakh. So how you'll get value of X? Right? If 40% of X becomes 8 lakh, then 8 lakh divided by 40%, you'll get annual sales. So let's write down. MOS sales is equal to 60% of total sales. MOS sales is equal to 60% of total sales. This is given. Hence, BP sales is equal to 40% of total sales. Hence, BP sales is 40% of total sales or annual sales, whatever you call. Therefore, total sales is equal to 8 lakh divided by 40%. I hope you are getting it. 40% into this annual sales is equal to 8 lakh. So 8 lakh divided by 40% is your annual sales. So your total sales is equal to 8 lakh divided by 40%. That is rupees 20 lakhs. So this missing data we have calculated 20 lakhs. Now from this 20 lakhs annual sales, I will reach up to profit after tax and I will get the ratio. So below write down statement of net rate of return on sales. The word used by the institute is net rate. That is net of tax. That is to be understood because tax rate is also given. Statement of net rate of return on sales. Particulars right hand side rupees. Particulars right hand side rupees. Let's go. Point number A, total sales, which we just now calculated. Total sales 20 lakhs. B, contribution. Point number B, contribution at the rate of 60% of sales. Your PV ratio was 60%. So contribution at the rate of 60% of sales, that is 60% of 20 lakhs is 12 lakhs. C, fixed cost. Fixed cost is given to you in the question, 4,80,000. Point number D, profit. But you will write profit before tax because in marginal costing we always get profit before tax. So it is profit before tax, that is B minus C. Profit before tax B minus C, that is 7,20,000. Now we have to deduct tax. Point number E, tax at the rate of 40%. Tax at the rate of 40%. So 40% of 7,20,000. 40% of 7,20,000, that is 2,88,000. You'll get point number F, net profit after tax. Net profit after tax, D minus E. Net profit after tax, D minus E, that is 4,32,000. Done. And this 4,32,000 divided by 20 lakhs into hundreds. So you will get net rate of returns. Point number G, net rate of return. Net rate of return, that is F divided by A. Net rate of return, that is F divided by A into 100. And this is the answer, 21.6%. 21.6%. Those who got this answer earlier on their own, very good, congratulations. You have done a good job, right? Those who got this answer already, 21.6%. Now friends, I will take you through one alternative route also. That is a shortcut route to reach to this answer, right? Using one of the formulas which we have discussed. So though we have already got the answer, but this is through a longer route. I will take you through a shorter route. Now what is that shorter route? Just understand first. See, we had one formula called net profit is equal to margin of safety sales into PV ratio, correct? This is actually formula number 16 written in your list of formulas. It is 16 number formula. Net profit is equal to margin of safety sales into PV ratio. I will just twist this formula. I want the answer in percentage, not in amount. This formula will give you the answer of net profit in rupees. We want it in percentage. So what I will do, and we want net of tax. So if I want to convert this formula into net rate of return, net of tax, what I'll do, I'll take, instead of margin of safety sale, I'll take margin of safety ratio, percentage, into PV is already ratio. By this, I will get profit as percentage of sales, but before tax. I will do it 1 minus tax. If you remember, FM adjustment, I will deduct tax, remaining will be profit after tax. So I will just convert this original formula slightly and directly get the answer in percentage. It will work. How? Let us see. Write down alternative method. Alternative method. Write down rate of net return on sales. Rate of net return on sales is equal to rate of net return on sales is equal to, in one bracket, MOS ratio into PV ratio. MOS ratio into PV ratio. We are taking ratios only. Actually, this will give you profit to sales ratio, but before tax. But only this much formula you will get, profit to sales ratio, but before tax. Okay, and before tax to be converted into after tax. So I am multiplying it by 1 minus tax rate. So it will get converted into after tax. So into 1 minus tax rate. Into 1 minus tax rate in another bracket. Done. Is equal to margin of safety ratio is 60% given in the question. PV ratio we have already calculated, that is also 60%. That's a coincidence, both are 60%. 60% into 60%. And into, in another bracket, 1 minus tax rate. Tax rate 40% means 0.4. Writing 0.4 and 40% is one and the same. So 1 minus 0.4. I hope you know this. To convert anything into after tax, from pre-tax to post-tax, you have to just multiply it by 1 minus tax rate. Now convert all of them into decimals. 60% I will write as 0.6. So 0.6 into 0.6. And this whole bracket will also become 1 minus 0.4 will become 0.6. So 0.6 into 0.6 into 0.6. This is just a coincidence. It could be different. Coincidentally, all the three figures are 0.6 into 0.6 into 0.6. So you will get it as 0.216. My dear friends, writing 0.216, and if you multiply it by 100, it will get converted into percentage. So writing 0.216 is as good as, that is 21.6%. Same answer. 21.6%. Got it? It's very shortcut approach instead of going through long cut. Now please remember, this approach should not generally be used because it is dangerous to use this approach. All this percentage can be multiplied just because of one reason. Why this is working? Let me tell you. Because you wanted the answer as net rate of return on sales. You wanted final answer as percentage of sales. Margin of safety ratio is expressed as percentage of sales. PV ratio is also expressed as percentage of sales. PV ratio is the denominator, base is sales. And final answer also you want as percentage of sales. Therefore it is working. If the base of different ratio is different, then the formula won't work. Fortunately, the ratios, the denominator for all of them is sales, and therefore you got the final answer 21.6% of sales. So though earlier route was longer, but that route is safe as compared to this route. Okay. So my dear friends, this was the question number 11. Now we have completed the basic questions. We have completed the basic questions. If you remember, with 11 number the basic questions are over, and now we are moving to actually CA final level. That is use of another type of BP, cost break-even point for decision making. Cost BP is different from your normal BP which we calculated. But I think today we have already spent sufficient time together. So from here onwards, we'll start tomorrow instead of starting today. I will start the journey of cost BP for decision making, concept related questions, and we'll go ahead. So from here slowly we'll start the journey of CA final from here onwards, from tomorrow onwards. Now my approach is I'll take you from simple to difficult question. I'll slowly and slowly accelerate the speed so that you won't feel the jerk. I won't suddenly take you to very high level question. That is what you would have realized. So we started with very basic or simple questions from calculation of BP, and we have revised the intermediate background of marginal costing and CBP analysis. Now I'm just going to start with the final level. Again with simple questions, and slowly we'll keep on increasing the level. So today I would like to stop here, my dear friends. See you tomorrow. From tomorrow we'll begin with cost BP. Okay friends, bye bye, see you tomorrow.